All right, we'll be talking tonight about, again, the Plungers. They've been around for many years. This is Nicholson's numerical guidance. Again, it's just another guideline, but he basically said that with either your personal portfolio or in your investment club, when you reach the point where the amount that you're putting in, the total deposit monthly that you're putting in, becomes less than 10% of the value of your portfolio, you may want to place a little bit less emphasis on that the foundational stuff, the blue chip only stuff, and start looking elsewhere. Start considering your options. And in the case of the Plungers, this is their math. You can see they're actually very close to zero. So again, their emphasis should be on taking care of the portfolio. And again, being vigilant for opportunities for some of this other type of stuff. And you'll see that they're actually exploring some of those areas. So again, this guideline is what he offered up. We run the numbers through for many clubs, and typically, Nicholson was ingenious. Most clubs hit this point at 4, 5, or 6 years experience, depending on how they've been trucking along. So again, somewhere in that 5-year period, plus or minus a year or so, most clubs really should be encouraged to start thinking about some of this other type of stuff. Here's some of the definition of what he means by some of that other stuff. Again, this balanced fund approach. What he said is you approach that 4, 5, or 6 year type time frame, the club really should begin thinking in terms of potentially dividing the portfolio into 2 parts, into the classic growth or core, and then the other part, non-core. And he even was specific about a general guideline. 75% in the stuff that you've always been doing up to that point. You're going to keep doing that for the rest of your career as a long-term investor. So, for those of you that are out there that say, that Mark is sitting here saying up, straight, and parallel is no longer important. No, it's always going to be the predominant feature of the things that you do. It's for most people, it's going to be that 75% piece. It's the other 25% that we're talking about that's perhaps not necessarily so up, straight, and parallel. And again, here's some of the definitions that we've kind of tossed around for what's a core versus a non-core. We'll talk about this with the Plungers. Again, I think it really is in the eye of the beholder. Core companies are generally going to be companies with high-quality ratings that have been around for an extended period. They're going to be best of the best, leaders of their group, and a little steadier with their operating results and their returns to investors. What is non-core? Well, it's the opposite of the other. Companies that are more cyclical. We certainly have a few cyclical companies here in Michigan. How about the financial companies? I mean, you could make an argument that they certainly go non-core about every 12 years or so. If you actually look back to some of the financial disruptions that we've had over the last almost 2 centuries, it really does happen, every 10 to 12 years that we run into a really nasty moment with the financials. Other examples, we already talked about them. Emerging companies, could be a biotech company that's just emerging and starting to form earnings, or the low growth. And again, this is Nicholson's basically saying that it's okay to take that 25% piece, and that 25% piece could actually have a very large component of it hiding in cash or into shorter-term bonds, so that you're ready to go shopping when the opportunity presents itself. I mean, think back to your experience over the years, either as an individual investor or in a club. Haven't there been times when, if you're following that rule that you should stay fully invested in common stocks at all times, when that market takes that dive and you're sitting there looking at all these opportunities, good companies at perhaps the buying opportunity of decades in some cases, and yet you have no cash to pursue them with, or you have a bunch of depressed price securities that you really are in no hurry to sell to create proceeds to pursue some of those things that are really dynamic shopping opportunities. And that's Nicholson's strongest point. He says, you know what, you're going to see these opportunities. Markets are always going to have cycles. There are always going to be bear markets and corrections, and it actually makes sense for an experienced investor to hang on to some cash when conditions merit. And then he of course does disclaim it and say this is not going to be easy, and you do have to stay engaged. You got to stay committed and disciplined. Well, we're no stranger to that. This community is, if nothing else, patient, committed, and disciplined.
Mark, can I interrupt you for a second, please?
Yeah, go ahead, Ken.
We're getting a lot of requests for the slides themselves so that people can take notes on them. as they listen to the presentation a second time, will there be a place where the folks can actually download a copy of the slides themselves, maybe a PDF copy of the slides?
Oh, absolutely. In fact, I generally make them available as a PowerPoint, so you can actually access the PowerPoint slides, either the entire presentation in the Manifest forum, if you're a Manifest subscriber or trial subscriber, and then we will actually put a link on our Facebook page, facebook.com/Manifest Investing, and then if neither of those work for you, we're always send me an email. My email address is markr@manifestinvesting.com, and just tell me what you want. And again, we'll be happy to send them to you. I do have a couple people that I do send PDF versions to, so just let me know how we can make you happy, and we'll certainly do that. Anything else at this time, Ken?
Thanks, Mark. That'll short-circuit some of these questions that are coming
Okay.
through right now on the question board. Thanks a lot.
Yeah, just a general purpose. We try to make these presentations, and by the way, the audio, the playback of this presentation, both the audio and the video, will be available on the Manifest forum and on the Facebook page relatively soon. So you can go back and just kind of kick this stuff around. I understand that it's challenging. Nicholson certainly understood that too, and just stuff that you really want to scratch your head carefully and ponder. And I'll just share with the group. Ken Kabul and I spend a fair amount of time riding in the car from place to place, and we kick this stuff around. I mean, we definitely scratch our heads, challenge each other, and every once in a while I persuade Ken, and vice versa. And it's a very healthy thing to do as a long-term investor, to be skeptical and curious and explore this type of stuff. I'm going to hit just one last example here to just kind of whet our appetites. This is an example that it's a case study. Ken and I actually put on a presentation where we do a number of case studies, but this is one that really seems to capture the curiosity or intrigue of audiences, and it has to do with a situation that I failed to take advantage of. It's a type of investing opportunity that Ken and I are referring to as opportunistic investing, and this is one that I would actually throw into the category of a motherlode moment. The company was Select Comfort. They'd actually been featured by the Motley Fools in their Hidden Gems newsletter at the time of that green arrow that you see about right here, I believe 4 times. It was the only 4-time selection in the Hidden Gems newsletter, and I think I probably bought it with real money sometime around that time frame. And we also featured in our expected returns newsletter, our Solomon Select tracking portfolio, sometime around that time. Well, the Great Recession hit, as shown by the gray shaded area here, and the stock price went from just short of $28 a share that you see right up here, all the way down to the 19 cents that you see here. And a good friend of mine, fairly young guy, and I were talking one day, and he said, you know what, this company has actually shown itself over the years to be a fairly well-managed company. For those of you that are not familiar with the company, this is the Sleep Number Bed Company, where you can dial up a setting and it softens it or firms it up depending on who you are and how you sleep. And they actually had done fairly well for, I'm not sure how many decades, but an extended period going into this. So they weren't a new company, still relatively small, mind you. But I mean, they've gone from just short of 29 down to 19 cents a share, and the housing market has something to do with this. They're under tremendous pressure and competitive pressures from Tempur-Pedic. Lots of things going on that drove that price way down there. But my colleague actually pointed out that, you know what, despite all that other stuff that's going on, this company still has a B+ financial strength rating. Now that is just an average rating, but it's a far cry from a C rating at Value Line. So again, the company is probably not going to disappear from the planet anytime soon, and we'll talk about that a little bit more. But what I think this is an example of, and that's why I've got the pendulum over here, there just are these opportunities that come and present themselves every once in a while where the pendulum just swings way too far one way or the other. And this is a case where the stock price had probably plummeted to levels which were just no longer reasonable. And in fact, I sit here wondering today why this company didn't find a way to go private down around those levels. But again, a pendulum that just swung too far to one direction or the other. And my friend asked a very simple question. He said, do you really think the last mattress has been sold? Do you think that the last house has been built? And went on to point out that this company has virtually no long-term debt. No long-term debt. So again, even though that stock price is way down there, there's probably some notion of potential delisting. No long-term debt. Going to have a lot of trouble going bankrupt under those conditions. And then draw your attention here to just this again. We're talking a little bit about cyclicals here tonight. You know, how did this company respond going through a cyclical dip, you know, in the Great Recession? And the answer is the sales trend, you know, got hammered. But over the longer term, and again, if you went back a few more years, you can see that this is a company that had a low but positive growth rate going forward. So if you could have brought yourself to believe back in that time frame that it was feasible for this company to return to those type of sales levels. By the way, these are, you know, that's an actual for the last one, but these are forecasted values for the next couple of years. If you could have forced yourself to believe that, this was a company with an enormous projected return back in that time frame that we're looking at, you know, with the stock price down here. And again, the fact of the matter is $1,000 invested in this company back around Christmas time, 2008, that's not that long ago, folks, is now worth nearly 65 times that amount. So again, this is an example of opportunistic investing that doesn't necessarily follow some of those long-term rules that we've been talking about, but again, it has some very, very solid foundations and the type of thing that we probably should be vigilant for. And again, for most of the people here, it could definitely be a situation where, you know, that $1,000 could have been regarded completely as risk capital, and certainly is a very rewarding potential situation. So we want to be watching for some of those. We're going to talk about some of those later. So let's transition now into talking with more specifics about the plungers themselves. This is the kind of the dashboard, or the look at the plungers that we take every month in the dashboard diagnostic session. Again, we ground ourselves by realizing that the average or the median stock right now has a projected return of about 8%. So again, we're trying to hit that sweet spot, maintain our portfolios, you know, somewhere in that you know, +5 to +10 range. That's what's happening over here with the target range that you see. We want to aim for, you know, buying stocks which will bring that portfolio up into the range of, say, 13 to 18%. And you can see that the plungers are close, just a little bit short. This is actually a very solid situation. The second key characteristic that we follow for any investment club is, again, and this protects us against corrections and bear markets also, is the quality. And again, they're kind of in that sweet spot. As I mentioned, you know, working with all those clubs over the decades, you know, watching best practices and the more successful clubs, what we notice is that the clubs that seem to be fairly more consistent with better results over the long term were those that had decent overall quality. And that certainly is true for the plungers. They're right in the middle of that range. Again, there's no, I can't give you any hard and fast number other than to say that, you know, 75-ish plus or minus 10 or so is certainly where you want to be. And in markets like today's market, you probably want to favor the right-hand side of that and raise quality under present market conditions. And then third, but not least at all, is this notion of having enough small, medium, and large companies so that that number does add up to something in that 10 to 12%. Again, here's your target range, 10 to 12%, and the plungers are certainly within it. So again, I look at the plungers portfolio. We'll look at the stocks here in a few minutes. Fine on the quality, fine on the overall growth mix of the portfolio, you know, outstanding, and just a tiny bit short. So all they want to, on the projected return, so they'll want to be shopping for opportunities which will boost the overall projected return of the portfolio. The other characteristics here that we see are just to kind of keep us grounded. Those are all also quite good. That financial strength rating is basically equivalent to an average financial strength rating of A+, if you want to think in terms of the value line universe. Here's a look at their sector diversification. It is a little bit, they do have some funds. We'll talk about that also. But again, fairly well distributed, no single sector overpowering one. One of the reasons that they have done and maintained fairly strong performance through these last 10 years probably has a lot to do with the fact that they've got this one, staples, because you remember that was one of the top 3 performing sectors over the last 10 years, as was industrials. And you see that they have pretty solid positions in those two. They also have a position in energy. And then they have more traditional positions in technology and healthcare. But again, fairly well distributed, nobody overwhelming the group. I do believe they're the first investment club in the state of Michigan that I've ever dealt with that didn't have a discretionary stock, though. That's maybe a subject for another time, but kind of fascinating that they didn't have any consumer discretionary stocks in the portfolio as of right now. Just a quick reminder about what is important. We've used this slide at a couple other dashboard diagnostic sessions. Again, first of all, invest regularly. Get in there, commit, maintain that discipline and patience and commitment. But again, I do like to make the point, and I certainly experienced it, sitting in the living room with these ladies. This stuff really is about more than money, and that may seem a little bit softer, a little bit sentimental, but you talk about the friendships and the support systems that develop over time. I mean, we certainly have seen it with the Beardstown ladies and the stuff that they have done for and with each other, and I just get that sense from the Plungers also that it's not just about the money. They're certainly very serious and very businesslike about the money, but it also has to do with this element of just leaning on friends. So invest regularly, stay disciplined and committed, but also this second notion of be prudent. Always be curious, always be checking stuff out, be skeptical, learn the lessons of history, learn what diversification matters. For example, we talk about sector diversification, but that is, in my opinion, and I think Ken shares this one, it's not nearly as important or performance generating as the diversification of having the small, medium, and large companies. So seek that balance of growth. And then that last statement down there, some that we're going to talk about. We're going to talk about it a little bit tonight. We're going to talk about it more going forward, but this notion of preserving capital when conditions merit it also. And then one last reminder that anytime you're studying stocks, center your studies on those 3 characteristics of the returns that you forecast. What are your expectations? Keep the quality in mind because that protects us during corrections and bear markets. And third of all, the growth does matter. And then just this reinforcement that when Nicholson said buy and hold, that was not the end of the sentence, buy and hold. And it is for as long as it makes sense to do so. And I know that the Plungers are not afraid to sell stocks. We have had clubs which were very reluctant to sell stocks, but they certainly don't fit that mold. They have been. So here's a look at, I'll let you catch up here for a second. I'm going to spend just a second on this page. This is their worksheet for the meeting that they shared with me, I believe, last week. And again, we're going to go into this in a little bit more depth here in a minute. I just want to point out that they've actually taken the step. I believe 2 or 3 of their ladies attended one of Ken Kabula's Model Club meetings, the BI Brighton Club, several months ago. And they came away from there with a bit of enchantment about the possibility of some of the ladies, some of the partners within the club being a little bit more aggressive. I mean, they basically have, again, 75% is still committed in the things which we would think of as core stocks, but they have this 25% of the portfolio in stuff that's a little more aggressive, a little bit more experimental, and certainly higher risk. But again, it's something that they are well equipped to pursue. They've got some people that really thrive on that, and why not turn that loose? As long as everybody in the club, and I got to tell you, I mean, I'm sitting there looking around the room, all the faces were engaged, and I didn't get any feeling that that anybody was ready to set anybody else on fire or anything like that, because I don't condone violence in investment clubs, and again, this just seems to be a solution which has helped. You can see that they've got a sector diversification chart there at the bottom, and then some of the stuff that we've been counseling over the last several years that they go through and think about. So again, the key takeaway here is that at least the front side of their worksheet, they've got these divided, and they're actually beginning to think about their core stocks one way and their non-core stocks another, exactly the way we coach and recommend that people do. Here's a look at one of our traditional dashboards, and again, this is the Plungers portfolio, And what I've done is gone ahead and color-coded in yellow over there on the left the ones that are regarded as and by the plungers as their non-core or their general market security type stocks. You can see that they're not necessarily household names to everybody. They could be, in this case you can see EBIX, at manifest the asterisk means that it is not in the value line standard edition of 1,700 companies. And in our surveys, our community surveys, we find that anytime that there's an asterisk there, most of us in this community, in this room tonight, will actually regard that company, or more likely to regard that company as a non-core company and think about it and follow it and treat it differently. You're going to treat EBIX differently than you treat Aflac, just period. You can see they also have a global. Actually, I believe that's an international mutual fund as part of their holdings, and I've actually included cash in the non-core as they have. This is sorted, as we always do, from top to bottom, from the highest projected return to the lowest projected return. And before anybody asks the question, I actually captured this slide before we had made an adjustment for the 2-for-1 stock split in Fastenal. This is 2-for-1. So literally minutes before I prepared this, the stock price was 64, right? And we caught up with that later in the day. In fact, we'll go to a live demonstration if time permits here in a few minutes. You'll see that the 26.1 was messed up for a few minutes while we caught up with that stock split. Again, the stock that we're going to look at, though, is Cephalon, with the lowest projected return in the portfolio. I'm not sure if the club has decided to do anything with this yet, but there's a reason that it has the lowest projected return in the portfolio, and here it is. Teva Pharmaceutical is buying the company for cash. They're not going to use their shares, so it's a cash buyout somewhere in that $80 range. Just want to point out that the first offer came from Valiant Pharmaceutical, and you can see this huge gap up from 58 to 76 or so, and then you can also see the gap a few days later where Teva made their final bid up in that $80 range. And then one of the other things that you might want to become more familiar with for less traditional, less classical stocks, the non-core, the general market securities, is this website called stockcharts.com. And what we see here from stockcharts.com, here's the website, stockcharts.com. So this is a stock that obviously has a huge amount of momentum because of these huge acquisition-related price moves. And this is the relative strength index. Again, you can go to the chart school at stockcharts.com and learn more about it. But relative strength index is one of the momentum indicators. And again, this is just basically saying how much higher can it go. I mean, it's going to top out. I'm not sure what the exact dollar buyout was. It was 81.5 or 83 or whatever. So it's within striking distance of that. And again, if this were my portfolio, if the plungers were literally handing it to me, saying, "Mark, it's yours to take care of," the way I regard these situations is this has nowhere but downside. The only thing that can really happen here is that the deal falls apart. And if the deal falls apart, obviously there's some question as to, how far down would this restore or return. There's not a lot of upside. I mean, there could be a superior bid made on the company. That's still a possibility, I suppose. Again, I didn't study it in any great detail, but again, in these acquisition situations, you see that the stock price has been flat for the better part of a month here, and it's probably time to just move on to the next, take the cash and find another investing opportunity.